moving right along. So, more tax credits. Child tax credit. So, child tax credit was one of those partially refundable credits. And so, like the other partially refundable credits, we already talked about the American Opportunity Credit, which is partially refundable. Those refundable credits are extremely valuable and prone to fraud. So there are additional requirements on preparers and on taxpayers for utilizing those credits. Child tax credit is one of those that requires that. So the taxpayers are allowed a $2,000 tax credit for each qualifying child. So we need to figure out what exactly does qualifying mean. By the way, this has been increased to $2,200. I think it's starting in 2026. It might be starting in 2025. I'm not 100% sure. But it's part of the new tax law. But it's temporary. It's only for 3 years. So it's going to set to expire or set to sunset. I don't know if any of you had kids during COVID, there was a year there where they upped it as well. And they actually sent out checks to people who were going to claim it. Even if you didn't want the prepayment check, you still received it. You had to tell them that you didn't want it. But anyway, so this is kind of one of those things. It changes now and again. And the idea behind it is to give parents some sort of tax credit for each of their qualifying children. So the qualifying child has to be a qualifying dependent. So you kind of have to refer back to Chapter 2 and the requirements for being a dependent, but they also have to be under the age of 17 at the end of the tax year. They have to be a U.S. citizen or resident, and they have to have a Social Security number as well. They also have to be younger than the person claiming the credit for the child, and they have to be unmarried. So we've got Xavier and Paula, have a son Marco, age 14, qualifies as a dependent. Family are all U.S. citizens. Marco meets the requirements to be claimed as a dependent. He is under the age of 17 and is a U.S. citizen. They are then eligible to claim the $2,000 child tax credit. It is refundable up to $1,700. Now, I don't know if that was also changed with the new tax law, but for your purposes and for your assignment and everything, you're going to go by these tax rules. But so it is refundable up to $1,700 per child. So how does that work? They've got some examples here. We've got taxpayer A has 2 qualifying children and a tax liability before credits of $5,000. They're going to get the full $4,000 tax credit. It's going to reduce their tax liability to $1,000. Okay, so obviously at $5,000, the refundable portion doesn't really matter because their tax liability is higher than the amount of the credit would be anyway. That refundable part only comes into account when your tax liability is less than what the amount of the credit is. Taxpayer B has 1 qualifying child and a tax liability before credits of $1,200. If they were to take the $2,000 child tax credit, they're actually going to get a refund of $800. So they're going to get $800 back even though they didn't have that tax liability, but that $800 is not more than $1,700, so that's fine. All of that tax credit is going to be refundable to them. Taxpayer C, 1 qualifying child and a tax liability before credits of $200. So 1 qualifying child, they would ordinarily be entitled to a $2,000 tax credit, but their tax liability before the credits is $200. Prior to any limitation on the refundability, it would result in a refund of $1,800, but they're limited to $1,700. So essentially, they get the benefit of eliminating that $200 and then an additional $1,700. So they're kind of getting a $1,900 child tax credit in that case, but it's because their tax liability is too low for them to be entitled to the entire thing. But they do get $1,700 back that they didn't owe in the first place. There's also So 17 is pretty young. Like I said, they take this away just when the kids start to get really expensive at the age of 17. There is an additional $500 non-refundable credit for qualifying dependents who are not qualifying children. So this would be for those kids, other types of dependents, but it's also for kids that have reached the age of 17 by the end of the tax year. So if you've got a kid that is, unfortunately they turn 17 on December 31st, you don't get the child tax credit at all that year, even though they were under 17 for pretty much all of the year, because they're, as of December 31st, they're 17 years old. They no longer get that child tax credit, but there is a $500 credit for other dependents, so they would be entitled to that, taxpayer would be entitled to that $500 credit. Qualifying dependent would be one who meets the definition of a qualifying relative under that Chapter 2. So if you remember, we had qualifying children, and then we had qualifying relatives as well. They also, the qualifying relative has to be a U.S. citizen or resident. They can't be filing a joint return with a spouse, and they cannot be claimed as well for the child tax credit. So there's no double dipping there. You wouldn't claim them anyway for the child tax credit if they were a qualifying dependent. You would just, if they qualified for the child tax credit, that's what you would take because it's a much more generous credit. So same example, but Marco is 20. He lives at home, does not work, and attends university full-time. Marco is a dependent, but he's not under the age of 17, so he's 20. Therefore, he's not eligible for the child tax credit. However, Marco meets the test to be a qualifying relative, so they can claim the $500 credit for qualifying dependents for Marco. So there is an income limitation on these credits, though. They are reduced by $50 for each $1,000 or fraction thereof that modified adjusted gross income, so there's that term again, modified adjusted gross income, is in excess of $400,000 for married filing jointly, $200,000 for everybody else. When modified AGI reaches $480,000 or $240,000, it's completely eliminated. So we've got a phase-out range for that credit that starts at either $400,000 or $200,000, ends at $480,000 or $240,000. Anything above that, any modified AGI above those amounts, you do not get the child tax credit or the credit for other dependents. So here we've got an example, Taylor and Drew. They've got two qualifying children and they file jointly. Their modified adjusted gross income is $416,322. So that is in that phase-out range. It's between $400,000 and $480,000 for their filing status. Their child tax credit in this case is going to be $3,150. So if their income was under $400,000, they would get a full $4,000 tax credit, but because it is $16,322 into that phase-out range, now their tax credit is going to be reduced, and this is how we calculate it. So we take the modified AGI minus the bottom of that phase-out range. We divide it by $1,000. So again, so we take our modified AGI minus the bottom of the phase-out range. We divide it by 1,000. So what we come up with there is usually there's going to be a decimal involved here, and that's what they get. So 16.3, and then we round that up. Okay, so first we do this. Step 1 result, round to a whole number, round up. So even if it's, so this is 16.3, we're still going to round it up. So even though it's less than 16.5, we're still going to round it up. So we'll round it up to the next whole number. And then we're going to take step 2 times $50. Okay, because as it says here, it is reduced by $50 for each $1,000 that is in excess of that amount. So it's in excess of that amount by 16.3. So 16,300. So we're going to round up to 17. Step 2 result times 50. And then this is going to be step 3. Whoops. Full credit that they would qualify for. So in this case, the full credit that they would qualify for otherwise would be $4,000. We're going to take the full credit minus the step 3 result. Okay, so there's the steps to get there. So for example, let's say we had somebody who is single, and their modified adjusted gross income is, let's see, 225,000, and they have one qualifying child. So let's plug this in. All right, so we're going to take their step 1, modified adjusted gross income, 225 minus 200,000 divided by 1,000. That gets us, what is it, 25? It gets us to 25, right? You get that right? Step 2, well, we rounded, this was a nice round number, so it's just 25. Step 3, we're going to take 25 times 50. It's 25 times, that can't be right. Is it 2.5? 225 minus 200, that's 25,000. Ah, that's right. Minus, let's see. These things are. So 25 times 50 is 1250. No, this is right. 1250. Here, step 4, the full credit that they would otherwise be eligible for one child would be 2,000 minus step 3 result, 1250. They get a $750 credit. Okay, does that make sense? So this is how you figure out how much of it, but this one as well. So if this were, let's say that this were 225, let's say this was 226. No, not 226. 225, 700. Now, that's not 25 anymore. This is, what is it, 25.7? That makes it 25.7. That changes this to 26. This would be 26 times 50. So this becomes 13. We would subtract 1,300. Now they only get $700. Okay, so every time you round that up, you're losing $50. Every time that number goes up by 1, they're losing $50 of their credit. Okay. Let's see. So there's a worksheet, and you guys have done the worksheet before that is used. I think there were some complications with the worksheet because they didn't give you the full instructions on it. But there's a worksheet that's used. There's no limit on the number of children, by the way. So if you have 8 children, you're getting $16,000 of credit. But if your income starts to get into the phase-out range, then it's going to be reduced. Questions?